Hello, and welcome to our series where we have some conversations with our strategic partners that help us execute these different tools, strategies for our clients. With us, we have Eric Alexander. He is from AssetMark. And AssetMark we use a lot because they have these very innovative tools that we're going to take you through. Today is all about a security-backed line of credit, which is kind of like having a HELOC, but on your assets. They have so many different tools like this. We're going to go into the tax management service the next week or in a few weeks. They have an incredible due diligence team that is one of the more conservative ones here in the industry that brings to us some of the top managers to help us execute on the investment side. We have trust consultants, the incredible service, PE tools, Morningstar analysis, so much of it that we wanted to bring it to all of you, our clients. So tonight we are going into that securities backed line of credit. I'm going to share my screen and hand it off to you, Eric, to take us through what this looks like, and we can talk about some case studies, how this has worked really well for some of our clients.
Yeah, thanks, Jessica. Appreciate being here. I'm really excited today to talk about one of my favorite programs in security-backed lending. Why it's one of my favorites and why everybody with investments outside their retirement accounts should have a security-backed line of credit is when you need access to liquidity, whether it's for an emergency, a real estate purchase, buying a business. There's really countless reasons why you could use an SBLOC. It provides access to cash when you need it without disrupting your investment portfolio and avoids realizing capital gains. So what we'll be covering today in terms of the agenda: what is an asset security-backed line of credit, and how can it improve your financial planning and outcomes? How do SBLOCs compare to other liquidity options that you may be familiar with? As Jessica mentioned, HELOCs are a popular alternative, and some of the pros and cons that a SBLOC can offer. Interest and advance rates, how we calculate how much interest is assigned to the line of credit and how much you can borrow from your securities. Also, the risks involved in security-backed lending. Like a lot of other services and solutions in the investment world, there are certainly some things that we want to be aware of to make sure that you have a good experience. And we'll go over some best practices and when a maintenance call would be required and how we would go about satisfying that. And then last, we'll finish just with some more uses for SBLOCs to kind of just inspire some ideas and some ways that people have saved some money in the past. So first, I want you to imagine for a moment, though, and we can go to the next slide here. You're driving to work, or maybe you're driving your grandkids to a soccer game, and your car breaks down, and the cost to fix it, it just doesn't make sense to do the repairs, and you need a new car. There's several ways you can pay for that car. You can get traditional auto loan financing. You could tap your 6 to 12 month cash reserves. You could request to sell 25 to 50K of stocks and bonds from your investment account to pay for the car. Problem is you'll still need cash reserves, so maybe that's not the best option to go with the cash, your 6 month rainy day fund. Auto loan rates can be very high, particularly for used cars. And if you want to pay the loan off early, it may come with pre-penalty payments, which also isn't appealing. So another option is you could sell some of your investments. After all, that's why you've put money aside to invest for situations just like this, right? But what if it's not the best time to sell from the investment account? What if there's other options so I can have flexibility to finance the car and pay it over my terms? This is exactly why security-backed lines of credit were created and what they can provide. Rather than exhausting my emergency cash reserves or selling stocks and paying capital gains tax on 15% plus potential state taxes, I can borrow from my security line of credit, and this allows investors to avoid paying those capital gains to access the funds, stay invested in the market, and hopefully continue to grow the account while often having a lower interest rate. Another common usage is for real estate transactions. Say you get a promotion, and that requires moving to a new city. Rather than waiting to sell your home, you could access your line of credit to put a down payment on the new home, and then pay off the line a few months later when you sell the first home. So, for example, if you're putting 20% down or 200K on a $1 million home, just for even numbers, that could trigger that $200,000 of selling securities. That could trigger tens of thousands of dollars in capital gains. And you're taking money out of the market and potentially missing out on future gains. However, with an SBLOC, it's simply paying interest on the days you have a balance on the line of credit, which can be far more cost effective and allows you to keep your investment portfolio undisturbed. For example, if my first home sells 2 months after I purchase the new home, I'd be paying interest on $200,000 for 2 months. Assuming an interest rate of 6% and I'm borrowing $200K, I would have paid off I just paid over 2K in interest, which is likely much less than I would have paid in taxes by selling a portion of my investment portfolio. But I also have the benefit of staying invested. What if the portfolio was up 1% over those 2 months? Well, assuming that the additional 200K is working for me in the market, that 1% of 200,000 is 2K, which is about what I paid for the interest. This is why SBLOCs can be so powerful when you're planning, particularly when the stock market is down. For even numbers, let's assume we have an investment account of 1 million and we see a 20% drop in the market, which can be more common than people realize. About 1 to 2 times every 5 years this occurs. It actually recently occurred last April. And when that happened, your portfolio of 1 million would have gone down to about 800,000 with that 20% drop. What's worse than that is Murphy's Law decided to hit you hard. And going back to the car example, the car breaks down at the same time. In this situation, an investor may really want to look at an SBLOC so they can remain invested and fully participate in that recovery. Last year, when the market was down 20% from its high in February, and the low was in late March, early April due to tariff uncertainty, as you probably recall. But just a couple months later, by mid-June, the market had fully recovered from that low. So if you had sold that 50,000 in investments at the bottom of last year for that car, your portfolio would have gone from 800K down to 750, the 20%, for the million to 800, then the 50,000 for the car, and that 50,000 wouldn't have participated in that 20% recovery. 20% of 50K is 10 grand. So that's meaningful return that was missed out by selling investments rather than borrowing from the line of credit. So these are just a few examples. One of the main benefits of SBLOCs is how many situations they can be used for. This is only one limitation. An SBLOC, which you can borrow from the line of credit to buy, or there's one limitation, I should say, that you can't use for the line of credit, is that you can't buy more stocks with it. This is called leverage and can lead to bad results. You don't have to look farther than 2008 and see how leverage in the real estate market works for the economy and in your portfolio. So buying securities is restricted because leveraging has that additional risk and could create more likelihood for a margin call, which we'll go into in a little bit here on how that works. But if we could go to the next slide here, we're going to talk about some other options that you have for liquidity and why security-backed lines of credit could often be the best way to go. And apologies that this is a little light in terms of the print, but we'll certainly kind of go over the data here. So some of the benefits of an SBLOC compared to the other options. One, historically, it's the cheapest way to get access to liquidity. Everyone loves paying a lower interest rate. Because you already have these assets, it's more friendly for somebody to lend this to you. Think about a personal loan. That's just going on the basis of your credit quality. That's going to have a much higher rate because it's not tied to any collateral. And a lot of banks don't even do personal loans anymore. A margin loan is another option. Now, the difference between a margin loan and an SBLOC is margin loans allow you to leverage your portfolio and buy those additional securities. However, because of that additional risk, like anything else, they're going to charge you more to make up for that risk. So the interest rates could be much higher in that situation. Home equity lines is usually the one we see kind of most common. Those could be good in situations. I definitely wouldn't speak ill of them. They're great for accessing liquidity. Some of the kind of drawbacks, though, compared to the SBLOC, is that there could be costs with the application. It's a much longer process. They have to do a drive-by to appraise the property. So that could be a 2 to 3 week process to get access to the line of credit. And it also has a maturity to it. So in 5 or 10 years, you'll no longer have access to that line of credit, and any balance will have to be satisfied. With the SBLOC, no application fees. The approval process is much quicker. We're actually moving to a soft credit check now. But generally, when an application is submitted, the client has access to that line of credit within 24 to 48 hours. So certainly a much faster timetable, less fees, lower interest rates. So in a lot of ways, just a better experience for people looking to borrow. And what's also nice is your advisor can work with you. Let's say you need access to your line of credit and you're out of the country. They can do wire transfers for you. They can initiate draws for you. They'll also be notified every time your account is used. So they can also help you with planning and make sure that everything is kind of in line here. Which brings us to our next slide here in talking about how we get to these interest rates and how much you can borrow. So one of the things to be able to lend with our program on our platform is the assets have to be custodied on AssetMark platform. And so what I can do then is the advisor will ask, hey, what can this client borrow based on the assets they have? Well, what I do is all I need is your quantities and tickers from those securities. And I can show you exactly how much you can borrow on a given date based on the market value of your portfolio. Different types of securities have different advance rates. Cash and short-term treasuries are going to have a higher advance rate because they're traditionally less volatile. So they're safer to borrow against. Conversely, equities, which can show a lot more volatility, we're going to have a lower advance rate on that, really for your safety to avoid margin calls. As you can see here, the advance rate for equities is up to 70%. That up to is very intentional language. If you have a concentrated position in one stock, it's not that you can't borrow against it, but given the increased risk of a concentrated position, the underwriters and our lender will lower that borrowing power based on the risk of the portfolio, but doesn't mean that you can't get access to it if you do have a concentrated position. Mid-admissible and other higher quality investments can have a higher advance rate, as you can see here. But easiest just to have us run the estimate and we can show you. And then in terms of how the interest rate is calculated, there's two components to it. There's SOFR, which is the secured overnight financing rate, which is a fancy way to say it's a overnight lending rate that banks charge to institutions for cash. That rate right now is at about 3.65, 3.6% we've seen for the year. And so based on the size of the line of credit, the larger the line of credit, the lower the interest rate is going to be. So going based off that 3.6 SOFR calculation, a line size of $500,000 to just under $1 million is going to be right at about 6%. And then on the lower side here, lines of 5 million or higher, you're going to be looking at more like 5.4% on the interest rate. So very favorable financing terms there. And we can, as I mentioned, easily get you a proposal and show you how much you can borrow. So this kind of leads to, okay, now I know how much I can borrow. I kind of know a little bit more about the program. I've heard you mention margin call or collateral call a couple of times. What does that mean? What am I missing here? What's the catch? Well, if we go to the next slide, I wouldn't say there's a catch, but it's always important to know your product and make sure that you understand where the risks are. And where the risks are is if the value of the portfolio falls to a certain level where the loan to value is no longer in a comfortable position for the lender, and they're going to require a collateral call. So we're going to go through the math here and kind of how that works. And what's nice is our program and your advisor will be able to see this. There's different levels here, so they know kind of where you are in terms of risk. Blue being the line hasn't been used, green meaning very low usage, yellow meaning there's still amount on the balance, but you've used maybe 50% of the capacity of the line. And then you get into red, which is higher risk. So this is where we kind of have to dig into it a little bit. So when you get into the red, basically what that's saying is the outstanding balance is greater than the capacity amount, but still within the maintenance level. Now, what does that mean? Well, you have two, kind of in terms of the amount you can borrow, that can change over time. And for example, the capacity amount is how much you can borrow based on the value of the collateral today, while the outstanding balance is how much you owe. So if I were to borrow, if I had $1 million, let's say, and I was to borrow $700,000, and I borrow that $700,000 on day one, so I maximized the amount I could borrow, and the next day the market drops 1%, well, my portfolio is, if we were to apply for that line of credit today, I probably wouldn't get that 700,000 because of the market drop. I would get in the high 690s. But that's still okay. We're still not at a maintenance call at that point. Even though the amount has changed in terms of how much I initially had invested, and I maxed out my line of credit. Where you get into a collateral call situation, and we can go over the math here, each line comes with its own maintenance rate. And what you do is to figure out when a portfolio could potentially be called for a collateral is looking at how much of a balance you have out on the line of credit, and then dividing that balance by the maintenance rate. Now, for this example, the $1 million investment portfolio and a 700K SBLOC, that's generally going to have about a maintenance rate of 80%. So these are real numbers. So if we were to if I were again to borrow that 700K day one, the maximum amount, the portfolio would need to fall to a value of 875,000 or lower before there would be a collateral call. So that's that 700,000 borrowed divided by the maintenance rate of 80%. But what's nice is this calculation works if you borrow less than what the portfolio amount was initially. For example, let's say you borrow only 500,000 of what was originally $1 million in collateral. And let's say we have a big fall in the market, maybe a 2020 situation or an 08, and your $1 million goes from $1 million to, and the market drops 37% or so, and now you have 625,000. Well, this would be now your value of your portfolio to have that margin call. Again, it's what they owe that, or what you owe, that $500,000 divided by the maintenance rate, which is 80%, and that gets you 625,000. So as I mentioned earlier, for best practices, what a lot of people will do if they only need $500,000 to borrow, but they have the ability to borrow 700, they'll just ask for the 500 because they're going to get the same rate at the end of the day. But as you can see here, there's a lot more built in terms of when there's going to be a margin call. In fact, it's about a $250,000 difference, right? If I borrowed the entire 700, the margin call starts at 875. But if I just borrow half of that, or if I just borrow $500,000, excuse me, the account value would need to fall below 625,000. So this more or less is how this process works. If this is a little confusing to you, I totally understand that. However, this is why your advisor has total insight into what's going on with your line of credit. They're notified when there's activity on the line, so they can help you manage this. If you are confused by any of the math and how any of this works, we can make sure to work with you and help you understand it. So kind of just to summarize what we've talked about today and why this is such a great program, if we can hit the final slide here, is really just the flexibility and how many uses that an SBLOC can provide at the end of the day here. The classic example is real estate transactions. Generally about 50% of SBLOCs are used for that. If you're an entrepreneur and you want to start a new business, it's also a great way. Graduations, unexpected tax bills is another very popular usage for this. Anytime where you have an unexpected large requirement and you need liquidity to be able to access that. Just to kind of briefly add, as a new homeowner, I'm learning once a week now that something I have is, it's going to be, your heater might last another 5 or 10 years, or your air conditioner might last another 5 or 10 years. You may need to replace the roof in 5 or 10 years. Well, is it 5 years or is it 10 years? What's nice is I can keep my portfolio invested, not have to worry so much about my cash balances for when those things break down. Because if I do need access to liquidity, I've got my security-backed line of credit to be able to do that and have that money working for me in the market in the meantime until those things eventually do break down. And if the market happens to be down at that time, well, then I can definitely borrow. I'm going to be more, inclined to do that, to let the market come back, hopefully, and, not miss out on some of that return by borrowing a large chunk from or using a large chunk of my taxable account. So just some ways to kind of think about using this line of credit. The possibilities are endless and provides tons of savings. So talk to your advisor about how this can help you and how you can get set up with AssetMark. And in just a day or two, we could have you, being able to access something like this for those needs.
Amazing. Thank you so much, Eric. And you mentioned to me that you're excited to share. It's no longer a hard credit pull when we set this up, so we can set it up. It's a simple one extra page in the application. It doesn't take long at all. We just went through this with one of our clients. She was buying her dream house down at the Jersey Shore, selling her current house, but she wanted to have that down payment and not have that contingency. So we did this within a few business days. It was set up and the money was there on its way to her dream house for it. And I love the idea of, if you need it for a car, whatever it is, those emergencies, you do the line, and then we can tax efficiently unwind positions with what we're going to talk about next, that tax management service, or even adding in that donor advised fund component to it. So there's a lot more, and these work really well together, as hopefully everyone's going to see as the series continues on. Yeah. So thank you so much, Eric. We'll see you next time when we talk about that tax management overlay, which is some very powerful stuff. We're so excited about it.
Me too. Thanks, Jessica.
All right. Have a good one. Bye.